I'm at the Bins and Sculpture Garden today in beautiful Loveland, Colorado. I get asked all the time, what's going on in our market? Well, you've been hearing all about what's going on in our market from the news. Yes, it's changing. So how is it changing in the lender's world? Today I am with Peggy.Kramer. Peggy is from Elevations Credit Union. Peggy's going to be talking to us today about an ARM and what that is, and a fixed product. So this is Peggy.
Good morning. Thanks, Margaret, for having me.
You're welcome. So how are you seeing the market change in the lender's world?
Oh, it's huge. So obviously we're in an interest rate rising environment. So that has pushed a lot of people out of the market.
Meaning they can't afford.
They can't afford it.
Okay.
Because of the rising interest rates. Where you may be qualified at a 4% rate, that rate today is going to be over 5 on a fixed. So what I have been doing is showing people the difference between an adjustable rate mortgage, aka ARM loan, and the advantages to taking a look at that and starting out with a little bit lower monthly payment.
Okay, so tell me about an ARM adjustable rate mortgage. Who would you recommend that to?
Well, just about anybody. It depends on their comfort zone, and I want to make sure that they're knowledgeable and they understand what they're getting into. So let's get into the weeds of what an adjustable rate mortgage truly is. So you've got a 3, 5, 7, or 10, and that is your fixed rate. And when you will talk to people, they'll tell you, so I've got a 3, 2, 1, 5. What does that mean? So every 6 months after the 3 years, we're going to take the 3-year ARM, it adjusts. It can adjust 2%, either up or down, based on the LIBOR of the day, or that month, I should say. You're going to look at that being fixed for the next 6 months. Then it'll adjust 1%, either up or down again, and that'll continue on. It is an amortized loan over 30 years, so your rate is based off a 30-year amortization schedule on your payment. Your max that it can go up is 5%. Think about that. If that loan went up to 5% and you started at a 4% ARM, that's a 9% loan, right? Or it could be up to. So let's take a 3-year ARM loan. So 3 years and 6 months, your rate can adjust up or down 2%. And people are like, what do you mean down? It can go down, I want to sign up. That's not always true, right? So it's going to be tied to the LIBOR. Whatever the LIBOR is doing at that time when it comes to adjust, that's where it's going to go. If it goes down, then your rate would go down. But if it goes up, you have to be prepared to be able to make that higher payment. If that was to happen, I want to make sure that my clients understand that, and maybe the fixed is better. So if you do a 30-year fixed, you're going to be locked in and fixed and know what your monthly payment is going to be, at least for the principal and interest of it.
So what's the advantage to doing an ARM versus conventional?
Well,
why would you recommend it to me?
So the ARM loan, if let's say you were going to purchase a house and you know that maybe you're only going to be in that house a short time. Maybe you need to qualify with a lower monthly payment. You know, obviously everyone's income goes up as well. So you know.
Well, let's hope it does.
Yeah, let's hope it does, right? But on the normal side, in this environment, we're looking over 5% for a fixed, conventional loan.
Okay.
And what that means is you're going to probably refi that loan within the next 5 or 6 years. So when you think about it that way, most likely take advantage of the lower 4s on an ARM loan, save yourself some money, let's refi you out of that as soon as rates dip back down. Obviously, we want to look at the historical mortgage rates for the last few decades, and I think you have that to share with everyone.
I do. So you can see that information right here, the average rate over how 30 years?
Yeah, I think it was from the 90s.
Okay, from the 90s, so it's 8%?
Yeah, it was high.
So even in our 5% world right now, that really isn't bad.
No, it's not. It's not. And I think it's what you have the stomach for, and you have to understand that your rate can fluctuate and go up, which makes your payment go up. So I want to make sure that my clients understand that. The advantages with a conventional loan, you know what your payment's going to be. It's locked in, 30-year, 5%, let's say. With the ARM loan, the adjustable rate mortgage, you're not going to know what it will be in the future. So that kind of, you got to be able to stomach that. And I think a lot of clients can't do that.
Okay. With homes becoming more available to buyers, buyers don't need to bring a cash offer to the table anymore to acquire a home. So Peggy is here to help you through this lending process. So feel free to reach out to Peggy for your lending needs. Her contact information is below. And between the two of us, she can get you in the proper loan. I can help find you that house. So thank you, Peggy, for explaining an ARM to us. Peggy is knowledgeable in all different types of loans. In future videos, we will be discussing other ways to finance a home other than an ARM. So thanks for watching, and I will see you next Tuesday.